Okay, let's get right into it. We're unpacking the institutional analysis of the December 18th market close. The mission is simple.
Simple, but not easy.
Right. We need to cut through all the noise from the headlines and really extract the metrics that real money traders are watching. We want to know if there's any follow-through here.
We're looking for the footprints. The closing print can be so misleading,
Yeah.
It can look like a quiet day, but underneath, huge capital is shifting around. We need to find the conviction.
All right, let's start with the scoreboard there. It was a bit of a mixed bag, which is probably why the surface story was so confusing. The S&P 500 closed up a marginal 0.18%,
Barely green.
barely. The Nasdaq did a little better. It advanced 0.35%. But then you have the Dow telling a totally different story, finishing down 0.05%.
And that mixed result is exactly why the source material called the day a choppy mess. It's classic indecision. You had strong jobless claims suggesting the economy's robust, but that ran head-on into all this uncertainty around consumer spending. So you get this conflict, and nobody wants to commit serious capital.
But the leadership, that wasn't mixed at all. Technology was the clear outperformer, up 0.85%, all driven by that AI optimism coming back.
In the laggard.
Utilities,
Yeah.
down 0.60%. That's a classic risk on rotation. Money moving right out of defensive plays and back into growth.
A textbook shift.
Huh.
But, a risk-on shift can be driven by just a couple of mega-cap names.
Yeah.
That doesn't say anything about the market's real health. The question isn't what moved.
It's who moved it and with how much force.
Exactly.
So let's get into that. Past the index numbers and into the engine room. Volume. Institutional footprints. Did this narrow tech-led rally actually have any real backing?
It absolutely did. The volume confirmation here is pretty definitive. Volume was notably higher than the 30-day average, both for the S&P and the Nasdaq Q.
So this wasn't just some quiet pre-holiday session.
Not at all. This was a session where money was actually flowing. This matters because, when the S&P is up 0.18% on light volume, it feels like an accident, a drift.
But on high volume,
It means credibility. It suggests strong buyer interest, institutional participation, not just algorithmic noise. It tells you the move has a real shot at follow-through.
okay, so the high volume tells us something was bought, but the institutional behavior tells us when and how. The report says institutions were, quote, definitively buying the close.
That's the key takeaway right there, that late-day institutional exposure. You could see them pushing the indices sharply higher right into the final hour.
Snapping some of those multi-session losing streaks. The inflows were focused too, right? Tech and communication services.
Yeah, and the catalyst was Micron Technology. MU came out with strong earnings and guidance, and it just fueled this momentum across the whole AI sector. When institutions buy that late in the day,
It telegraphs conviction.
total conviction. They're setting up for tomorrow. They're betting on upside. That's the kind of fuel you need for a potential Santa Claus rally.
All right, so we have institutional conviction, we have high volume. Let's pivot now to the specific signals the market is sending about quality. I want to look at a couple of key reversals. Let's start with the big loser. FactSet, FDS, plunged over 8%.
Yeah, FDS was the lead decliner in the S&P. And this story is so much more important than just the number. I mean, for you listening, this is a masterclass in due diligence.
Because the headline numbers were great, they beat adjusted earnings, they beat revenue. Wall Street should have loved it.
Should've. But they got hammered. And it wasn't an overreaction.
So if it wasn't EPS, what was the mechanism? What drove the selling?
It was institutional algos prioritizing one thing over everything else: cash flow. The plunge was entirely because of weaker than expected cash provided by operating activities. And, of course, a slump in free cash flow.
So the institutions are basically screaming, I don't care about your adjusted EPS if you can't actually generate cash.
That's it, 100%. In this rate environment, cash is king. When those algos see a discrepancy between adjusted profits and actual cash coming in the door, it flags fragility. It proves headline EPS is not the final word anymore.
Okay, let's flip to the other side of that coin. The bellwether Micron Technology, MU, soared nearly 10%.
What a move. A big gap up at the open, and it's just rallied hard straight into the close. And this is more than just a win for MU shareholders. It's a huge psychological boost for the entire market.
It's the proxy for the whole semiconductor and AI pipeline.
Yeah.
It basically rekindled the AI trade.
It did. You really can't have a sustainable year-end rally without the semis leading the way. Its strong guidance signals that companies are confident they're spending on tech again. The institutions buying the close were buying that Micron story.
Okay, so a very clear picture so far. Institutional conviction in tech, confirmed by volume. A new focus on quality, confirmed by the FDS collapse. Everything seems to point to a healthy rebound.
But that's only half the story.
Exactly. Now we have to look at the internals because they're sending a deeply contradictory, almost worrying signal.
This is where the real tension is. You have conviction on one side, but you have massive hedging on the other. Let's start with breadth. Was this rebound just big tech, or did anyone else join the party?
The U.S. markets definitely bounced, recovered from that tech sell-off the day before. But what about broad participation?
It's a nuanced picture. I mean, the longer-term trend before today actually had some decent participation from small caps, from the equal weight S&P. So we're not totally dependent on the mega caps just yet.
But today's rally was narrow.
It was narrow. And there's this international warning flag in the analysis from the Indian Nifty market, a weak advanced decline ratio there.
And why should we care about that?
It's a signal of general caution in smaller caps globally. It tells us risk managers are hesitant to chase momentum outside of the biggest, most liquid names. We really need broader participation here and abroad to validate this rally.
No, for the biggest red flag of the day. The VIX, the fear gauge. I mean, on a green day with high volume, I expect the VIX to just get crushed. It should be melting away.
It didn't just fail to melt. The VIX edged higher today, up almost 7% to 17.62. And the really crazy part is the short-term VIX, the VIX 1D.
What did that do?
It jumped a staggering 41.7%. That is a massive critical signal. This is why the report uses that phrase, cautious fragility.
This isn't complacency at all. This is heightened vigilance. This is hedging.
It's like the market is having a small party, but everyone is standing next to the fire exit with their coats on. The VIX rising on an up day is the clearest divergence flag you can get.
What does it mean in practice?
It means people are buying protection. They're buying downside puts even as the index moves higher. They are fundamentally skeptical about how long this move can last.
And we've seen this before. The report mentioned that persistent bearish divergence in the Nasdaq just a few days ago, price grinding up while momentum was fading.
Exactly. When an index rallies, while implied volatility is also rising, that rally just lacks conviction. It suggests managers are being forced to chase performance, but they're doing it under duress. You have to be skeptical here.
Okay, let's get tactical. Let's build tomorrow's playbook, the look ahead. We've got major U.S. economic data coming, final GDP and personal income. Volatility is basically guaranteed.
Absolutely. And given these conflicting signals we're seeing, the analysis suggests positioning for a big directional move, one way or the other. The specific setup is an asymmetric trade using a long straddle or strangle on the S&P 500 ETF, SPY.
Just break that down for someone who doesn't trade options every day. Why a straddle here?
You're betting on volatility, not direction. A straddle is where you buy both a call and a put at the same price and expiration. You're basically saying, I don't know which way it's going to go, but I think it's going to move a lot.
And that GDP data could be the catalyst for that big move.
It's the perfect catalyst. It could confirm strength or expose a slowdown. Either way, the market is likely to react violently. The idea is the move will be bigger than the premium you paid for the options. It's a pure vol play.
Got it. What's the one key level, the gamma wall, that institutions need to hold to keep this bullish case alive?
This is the number you have to watch. The S&P 500 60-70-50 to 677-78 zone. This isn't just a line on a chart. This is the gamma wall.
Explain why that's so important.
It's where option dealers have massive complex hedging requirements. As the price gets near 67.50, those dealers are forced to buy the index to hedge themselves. It creates a mechanical floor of support.
But if it breaks?
If it breaks and holds below 67.50, that support vanishes. It can actually accelerate selling. That could trigger a fast move down towards 66.75. Holding 67.50 is the absolute pivot point.
Okay, finally, let's talk day two plays. How do we capitalize on this momentum if Micron's strength is confirmed tomorrow?
So if today was a genuine trend today, there's a good chance of continuation. We're watching two hypothetical names. First is Quantum Innovations, QTM, tech firm, gapped up on AI news.
What's the setup?
We're looking for a breakout above yesterday's high. You want to see analyst upgrades and new institutional buying driving the volume.
And the second play, something outside of tech.
BioCure Pharmaceuticals, BCRX, surged on huge volume from stellar Phase 3 trial results. The day two play here is driven by new analyst coverage and retail FOMO, chasing the move. You're looking for it to hold the prior day's high on the open and then push past resistance.
So to wrap it all up, the core tension is you have this clear institutional conviction, you have high volume, you have a bellwether like Micron leading the charge.
But that's all being offset by a stubbornly high VIX and these divergences that point to that cautious fragility just lurking right under the surface.
It's structurally healthy but psychologically fragile.
Perfectly put. Which leads to the final provocative thought for you to chew on as you watch the data roll in tomorrow.
What's it going to take to confirm a truly healthy uptrend, one that finally sheds this fragility and calms the options market down?
The source material gives us the answer. You need two things. First, sustained broad-based participation. Small caps have to join the party. And second, you need a calming VIX. It has to get back down toward that long-term anchor around 15. Until both of those happen, you have to stay skeptical, stay vigilant, and watch that 6750 gamma wall.
Sound advice. That's our deep dives into the December 18th close.